Welcome to Snapshots, where we discuss current events and trends in our economy. My name is Ibrahim Adrame, and I'm the Director of Education at the Henry George School of Social Science. My guest today is Raphaele Chappe, Professor of Economics at Drew University, and also a trustee at the Henry George School of Social Science. Welcome to Snapshot, Raphaele.
It's a pleasure to be here.
So in response to the COVID-induced recession, central banks have cut interest rates and resorted to massive asset purchases, otherwise known as quantitative easing. In your view, how would such policies affect income inequality?
Yes, there's a clear causal relationship between monetary and regulatory policy and inequality. Let me just give a brief background on where we are. We've had this long-term decline in interest rates. For a while now, the Fed began its practice of reliably and continually cutting the interest rates to accommodate shocks in response to the 1987 stock market crash. And it's continued, through the 2008 crisis. The rate kept going down and we're now at effectively zero. And that has led the Fed to begin these QE and large-scale asset purchases. During this entire time, U.S. income and wealth inequality actually grew worse. So the wealth of the top 10% grew 19% following 2008, and the lower in families, they lost 16% of their pre-existing wealth. So we've seen this happen already. Now, in response to the COVID-19 pandemic, we've had this global stimulus policy response in the range of 12 trillion that was deployed. And, the goal was to ease financial conditions and preserve access to capital markets and bank fundings and prevent liquidity crisis of the type we saw in 2008. The Fed has intervened with these large scale purchases. So in March 2020, it started buying and committing to buy a wide range of debt securities, long-term treasuries, but also corporate bonds. And the balance sheet expanded to 7 trillion. Just to give some numbers, in 2007, we had about 900 billion on the balance sheet. In 2015, we had 4.5 trillion, and we're now at 7 trillion. And that's about 35% of US GDP. Now, arguably, what the Fed has been doing is stabilize the money markets and preserve the value of financial assets. And while many people would argue, and probably I would agree that these measures may have been necessary, they also have a range of perverse, unexpected effects. We might call them negative externalities. So they have fueled inequality, as well as other dangerous trends that we might return to. But in terms of inequality, these interventions have dramatically increased the wealth of those who own stock, but the stock ownership is highly unequal. So just to throw some numbers, the top 1% owns more than half of US stock. The top 10% of households own 86% of stock. 45% of Americans don't own any stock at all. And this takes into account, retirement, 401ks, IRAs, etc. There's also a racial justice component to this. 60% of white families own stock, and versus about 30% for Black and Hispanic families. So the low interest rates and QE primarily benefit those who already have some level of wealth. It sends equity and bond prices through the roof. And you can see this, if you study finance, you can see through the valuation models, things like discounted cash flow analysis, that you have higher present values when interest rates are low. The gains from the wealthy are often reinvested, so it pushes up the asset prices even further. Without QE, some analysts from the French bank SocGen, they found that without QE, the S&P 500 and NASDAQ should be closer to 50% of their value. And it's not just the price of equities, but also housing and other assets that skyrocket and become unaffordable for those with lower incomes or net worth. Bloomberg has noted that despite the current low interest rate environment, US home buyers face the worst, quote, the worst affordability squeeze in 12 years. And this becomes even more problematic when Private equity investors, amongst others, begin to invest in assets such as housing. So to conclude here, one last thing on this very low interest rate environment, it's mostly big corporations taking advantage of these record low interest rates. In June 2020, Amazon had borrowed 10 billion in bonds with a record interest rate of 0.4% on the lowest tranche. And then the other side of the coin is for average people, average households, they earn very little on their savings in the bank. I found one study, there has been a loss of 2.4 trillion in savings due to these low interest rates from 2008 through 2017. The wealthier investors have access typically to better returns through more sophisticated investments.
Great. And we also know that one of the consequences of easy monetary policy with low interest rate is the debt issue, right? So with asset prices going up, the stock market almost reaching unprecedented levels. So are there reasons to worry that this might undermine the long-term stability of the financial system?
Yes, it's a very good question. What the Fed has been doing, arguably, is stabilize money markets, but at the cost of increasing the risk of a future financial crisis. So at the cost of adding to financial instability. These Fed bailouts arguably are creating vicious cycles in which risk grows higher and markets become more reliant on future bailouts. So why is there an increase in risk in the system? Well, these low borrowing costs, they've incentivized companies to take on more debt at a time when the corporate sector was already highly leveraged. So there's more debt, and this debt is also not properly priced. So the Fed backstop creates a misalignment between yields and credit risk. It's almost like this kind of insurance, if you like. And so this has enabled companies to really flood the market with newly issued debt priced well below its true risk level. So for instance, in the US, companies borrowed 2.5 trillion in the bond market in 2020. And this has driven leverage to an all-time peak. So for the time being, the answer to weak capital structures seems to be more leverage, right? Which avoids losses, but this may be just postponing and magnifying larger problems down the road rather than truly resolving corporate financial distress. On average, the company's ability to pay for this increased leverage has actually declined. So if you look at credit ratings, you'll see some downgrade. There's also been an increase in the number of so-called zombie companies. They're neither dead nor alive. And these are companies with just a very high interest burden. So all of this can quickly translate into liquidity crises and forced selling, and increases risk of losses across markets. So the ability to rely on increased leverage ultimately is constrained, right, by firm assets. It may not be continually available. Another risk factor is that both equities and debt securities are responding to the same primary driver, the liquidity that's created through QE. So the market valuations are increasingly driven by the same macroeconomic factors, things like credit spreads, the strength of the dollar, et cetera. And so as a result, asset classes are more correlated than ever. In June 2020, JP Morgan warned that market correlations were at a 20-year high. And that also creates systemic risk. And then finally, just to conclude on this point, right, just to point out that economic inequality is contributing to dynamics of secular stagnation, right? So the economy isn't growing as much as it should be. And unless this is addressed, right, we're looking at potential macroeconomic instability down the line. So inequality is really systemic risk.
So would it be an accurate statement then to say that monetary policy has reached its limits? And do you foresee a viable path to normalization?
This is a very good question and a difficult question. How to undo some of this? I mean, eventually the idea is for the central banks and for the Fed to start shrinking the balance sheet. But if 2008 serves as a guide, this may actually take some time. One of the concern here is, the size of this balance sheet now. The Fed's portfolio now, I found some statistics, is virtually half of the banking system in its entirety, and about half of US total economic output before the crash. So the Fed is becoming enormous, right? Relative to the size of the financial sector. Now, what has Fed said? It said that it would start to raise interest rates, which it needs to do. If the economy is at full employment and if inflation is at 2% and is on track to exceed this level. And thus far, this hasn't yet been the case, at least in terms of full employment. The goal hasn't been met, right? But investors, there's fears of inflation. And there's been some volatility in the markets. And so now what the Fed has done is just recently, this week, it has announced that it expects to start raising interest rates earlier than previously forecast, as early as 2023. And, that sent bonds downwards. So this process of reducing the size of the Fed balance sheet and starting to increase interest rates again, which is known as tapering, right, has really just begun. But the markets are responding with a lot of volatility. So this is going to be a challenging process of how to get an orderly rise in interest rates, right, without really destabilizing the economy. And a difficulty here is that the economy may have become so leveraged that the barriers to raising interest rates are actually quite high. This may be described as a debt trap, right? Like there's so many borrowers with significant debt burdens that as soon as you increase the rates, you increase the cost of servicing the debt, and so you could precipitate a solvency crisis. So communication is going to be key, right? The markets are very sensitive to any Fed announcement. Just recently, Powell said at the press conference that the process of winding down the asset purchase program and would be orderly, methodical, and transparent, and that things would be communicated well in advance. So there's still this commitment to transparency. But many people here believe that this is going to be a tricky process, and the Fed is going to have to be smart about how it does this.
Thank you, Raphaele. It was a pleasure speaking with you.
My pleasure.
Great, and have a great summer break, and I look forward to continuing this conversation with you later.
Thank you so much. Have a great summer too. Bye.
Thank you. That's it for this edition. For more information on our offerings, please visit henrygeorgeschool.org, and thank you for watching Snapshots.